Well, good day, traders, and welcome to the last of the video complexes we've been doing on YouTube for 2019. We look to take this back up in mid-January when markets seem to come back alive and we've seen a few market participations coming back on. I'm going to be taking an extended vacation, so I bid you all happy holidays and obviously look to come back with some new ideas and fresh commentary and a revitalised mind, I suppose, as we go into the new year, where I think it's going to be a really interesting one. Now, I've written a piece on the website today, which you can see in the description there. You can see the link to it, and I've given a sort of more detailed view of what's happened in 2019. Have looking at the performance of markets, and if you have a look at the performance of markets, it's been actually staggering gains. If you told me at the beginning of the year that we were going to see palladium up 57%, Bitcoin up 78%, US crude, WTI crude up 33%. S&P 27%, Nasdaq a little bit more, gold even up 15.5%. I've been bullish gold most of the year, but certainly, it's really been a case of buy pretty much everything. FX markets has been, buying the pound. That's been the superstar currency for 2019. Again, if you said to me at the beginning of the year we were going to see all these situations, I probably would have said, take a lie down and have a glass of water. But the situation is very much that we have seen central banks, supporting markets very, very strongly indeed, whether that's cutting interest rates down to the zero lower bounds, promoting this kind of there is no alternative trade to come through. People have been pushed out to the risk curve, and then we've seen the increased liquidity coming through with the top three central banks, the ECB, the Bank of Japan, and also the Federal Reserve increasing their balance sheets by 100 billion a month. Of course, we've seen convergence between the US and China. We've seen the phase one deal. We're now talking clearly about a reduction and a continued reduction in tariffs, not what we were seeing earlier in the year, which of course is how much further have tariffs got to go up. So you've got a situation where you've got that. Of course, you've got buybacks, reduced volatility structures that have been playing mainly from pension funds, and you've seen these very, very impressive results. But I think because of central bank action, we have stolen performance from the future. We brought that to the present value. I think it's going to be very difficult to generate anywhere near these kind of returns if you're a passive investor. You just got to go for benchmark returns. But we're not going to get these sort of performance returns in 2019. We're going to have to be a lot more selective, a lot more active, and trying to generate those kind of alpha through different channels in that capacity. So I don't think we're going to see a year like this. I think what's interesting, if you have a look at the interest rate markets, if you look at the pricing that I put through on this Bloomberg channel, if you have a look at the far right, you can see what's the number of basis points that are being priced in. And I think the market's got very comfortable with the ideas that central banks still want to see this pass-through rate of recent interest rate cuts into the real economy. And we're going into 2020, and I think the sort of irony of the whole situation is that we are expecting better global growth. We're expecting global growth at 3.4%. We're currently running around 2.9%. And we're expecting that to snap back a little bit, because of central bank action and that feed through, that lag effect that it takes to feed through into real economics. The irony of the situation, of course, is we're probably going to see worse performances from asset markets. So we need worry. We need to climb that wall of worry to create this sort of asset returns and get central banks moving. But we're in a much more neutral space. We go into the new year with markets, still pricing an element of rate cuts, but certainly very, very modest indeed. I think what's interesting today, if you have a look at the RBA minutes, which came through at, in the sort of mid morning session here in Australia. They've put the February meeting firmly on the watch list. They've basically said that they are still looking at economics, and they'll take a review of policy in the early parts of next year. Now, the market is saying that the February rate meeting is about a 50-50 proposition. So we are seeing some weakness playing through on the floors today here in the Australian dollar. Aussie Kiwi looks like a good short at the moment tactically if you look at that capacity, because if we get a poor jobs number this Thursday, let's say somewhere below 5,000, that unemployment rate perhaps even ticking up a little bit, then of course that pushes up that probability of a February rate cut, pushes up to 55, perhaps even 60%. Aussie Kiwi looks like a good short, but obviously it's based on the the idea that perhaps we will get a weak jobs. So there's no guarantee that's going to happen. And then we'll get a weak jobs number in 23rd of Jan, and we're talking about the cash rate in Australia coming down to 50 basis points as a fait accompli. The other big one I think was quite interesting today in the news stories is what's happening in the pound. We've seen a bit of weakness playing through in the pound. I think early in the early session we saw it drop about 50 or 60 pips off the bat. News reports have surfaced that Boris Johnson will look to change legislation, meaning that it's going to become legislatively very difficult, if not impossible, to extend the Brexit, the transition period deadline. A lot of people out in the market are saying that the transition period, where they're agreeing on the future relationship, the tariffs and various factors for next year, it's going to be so complicated that they will need to extend it by another 2 years, and probably that will take place probably June or July. By changing the law so they can't actually request that extension, it means they need to get everything done by the end of December 2020, and there's no guarantee that's going to happen. So it does bring no deal Brexit back onto the table in some capacity, and we've seen some weakness playing through in cable, and euro sterling's had a bit of a pop on the back of that as well. It is something that complicates matters and does muddy the water. Obviously Boris Johnson believes that he's going to get this done, and maybe he's putting a gun to the market's head in that capacity. So do take a look at the article, which we talk about what's happening and what's caused that, but also we do focus a little bit on the expected moves for 2020. You can see there on the chart not just how well markets have performed, or the calls from sell-side analysts have performed in 2019. Bit of a miss, obviously, on US 10-year. They missed by some 142 basis points, but also in those bit of a miss in gold, where they've under forecast by 14%. But yeah, so let's have a look at what the market's expecting for Q2 2020 and also into Q4 2020, and we've given the analyst range. Now, for me, forecasts actually just cause biases for trading. So, when you see it in the Wall Street Journal or the Financial Times that the consensus number for the S&P is X, do consider that does create a bias, and of course we don't hold positions for that long as well, so that actually negatively. But for me it does give you a sense of where the market expects the various markets to go for 2020 based on the risk rewards and the probabilities and the event risks that are coming up. And the one that we're looking at there is the consensus view that we're going to see modest dollar depreciation throughout 2020, so definitely something to watch going forward. But do take a look at the article, and obviously we bid you happy holidays, and we'll look to regroup and come back with some fresh ideas and fresh commentary in 2020.